The topic for this video is Module 7, Industry Controls, Chapter 19, Performance Evaluation. So here we are in Module 7, Industry Controls. The topic for this video is Chapter 19, Performance Evaluation. You can see that there are 53 questions in the learning ecosystem, and there's 9 learning outcome statements. The learning outcome statements for this chapter are A, describe a performance evaluation process. B, describe measures of return, including holding period returns and time-weighted rates of return. Learning outcome statement C, compare use of arithmetic and geometric mean rates of returns in performance evaluation. D, describe measures of risk, including standard deviation and downside deviation. E, describe reward to risk ratios, including the Sharpe and Trainer ratios. Say that 5 times quickly. F, describe uses of benchmarks and explain the selection of a benchmark. G, explain measures of relative performance, including tracking error and the information ratio. H, explain the concept of alpha. And finally, I, explain uses of performance attribution. So as you should be able to note, this chapter follows heavily on Chapter 8, the quantitative concepts. You really have to be up to speed on Chapter 8 to be able to fully tackle this chapter. And you see, this is how things start to come together and gel. I often teach portfolio management and these type of topics right after the quants, because you can see the quant feeds right into this. Learning outcome statement A is describe a performance evaluation process. So you can see there's a 4-step process here. Step number 1, measure absolute returns. Step number 2, adjust the returns for risk. Step number 3, measure relative returns. And then step number 4 is the attribution, or the you attribute the performance. Okay. So in terms of measuring absolute returns are the returns achieved over a certain time period. Absolute returns do not consider the risk of the investment or the returns achieved by similar investments. Step number 2 is adjusting the return for risk. Investors prefer higher returns but lower risk. And again, this is a follow-up. We've seen that in previous chapters on investment management. Measuring relative returns. By measuring relative returns, that is, returns relative to a suitable benchmark, investors can determine whether they could have made more money in other investments. So portfolios or mutual funds are always compared to some benchmark performance. Absolute performance is a percentage. We were up 2%. Well, how was that versus the benchmark? Well, our relative performance was better than the benchmark. The benchmark was 1%. So absolute performance, the 2% relative to performance against a benchmark. And finally, though, in terms of attributing performance, if it's active management, you want to determine how much of the performance is the result of selection of assets, classes, sectors, individual securities, and currencies. So breaking that 2% down into further measures, that's how you attribute the performance. Learning outcome statement B is describe measures of return, including holding period returns and time-weighted returns. So you can see the learning outcome statement is not calculate, it is describe. So the note from the reading is that, as always, you are not responsible for calculations, but the presentations of formulae and calculations may enhance your understanding. I think there's enough smart people out there studying for the CFA Investment Foundations program that are up to speed on the math, and having the math really helps complement the understanding. And then the good news is you don't have to do any calculations on the test, which you can probably gather because there's 120 questions in 120 minutes. That's 1 minute per question. It's fairly rapid. Anyhow, so here we're getting into the holding period return, and that is a return for a period, which could be a day, a month, a year, or longer. Okay, so you can see here, starting off in words, holding period return is the capital gain or loss plus the income divided by the beginning value. Now I've put it up here as a formula. Holding period return P1, that's the price at the end of the period, minus P0, that's the price at the beginning of the period, plus the dividend, usually we assume that's coming at the end of the period, divided by P0, which is the price at the beginning. So you can see I've also put it down here, HPY, Sometimes the HBY or holding period HBR, it doesn't matter, different nomenclatures, but simply it's the ending price minus beginning price plus the dividends divided by the beginning price. And as you can see, the ending price minus the beginning price, that's your capital gain or loss. Okay, so the holding period return is, I like to often refer to it when I'm speaking quickly, as ending minus beginning plus dividends divided by beginning. Okay, that's the easy way. But you can see there's different languages: capital gain or loss plus the income, ending price, beginning price, dividends. That's why I believe that understanding the algebraic formula, just summarizing it down to ending minus beginning plus dividend divided by beginning, and you're good to go. Okay, so anyhow, the example in the text is, assume that between 1st of January and 31st December, so that's 1 year, investment increased in value from £100 to 110, and it paid a £5 dividend. So number one, your capital gain, because we split the return between capital gains and income. Capital gain, selling price minus buying price, £10 profit, ending minus beginning, £10. Okay, and the income, or in some cases the dividends, £5. So the holding period return, ending minus beginning plus income divided by beginning, 15%. Nice little graphic in the textbook. Here was your starting £100 of the 1st of January, 31st December, you sell it. Your original investment was 100. You had the £10 capital gain because the stock was at £110, plus you had the £5 dividend. So your total return, ending minus beginning plus the dividend divided by beginning, 15% holding period return. Okay, hopefully that example for the stock was pretty easy to understand. The holding period return, ending minus beginning plus the dividend divided by beginning. But when we get into portfolios, you've got cash flows in and out of the funds. So you know that ending and beginning becomes a lot more complicated when you've got flows into the fund and flows out of the fund. Okay, so when there's many investments that pay income at different times, there's deposits and withdrawals throughout the period, calculating these returns is more difficult. So what basically essentially what you have to do is break it into smaller periods of time and calculating the returns on those smaller segments, and then calculating the geometric average return, and that's how we get a time-weighted return, basically. Okay. Anyhow, in practice, calculating a fund's holding period return is a complex process because funds may consist of hundreds of individual investments. They pay income at different times. Clients may make additional investments, cash inflows, and withdrawals, outflows from a fund. So in other words, there's a constant flow of cash into and out of most investment funds and portfolios that'll affect the calculated performance of the fund. Now we're moving on to time-weighted returns. Again, you're not responsible to do the calculations, but you have to understand them because the LOSs compare the use of arithmetic and geometric rates of return in performance evaluation. You use the geometric mean rates of return when you're calculating the time-weighted returns because there's cash flows coming in and out of the fund. And we learned about geometric mean rates in Chapter 8. This is why this chapter follows Chapter 8, the things that you learned in quant so closely. Anyhow, we're going to assume an investment fund is worth $100 million on January 1st, $98 million on 30th of June, $110 million on 31st December. However, on 1 July, $5 million was added to the fund. So I like to draw my timeline. Here I've got January 1, the fund is worth $100 million. On June the 30th, the fund has gone down by $2 million, and the fund is worth $98 million. That's on June 30th. However, on July 1st, which is just a day later, $5 million was added to the fund, so the fund would be $103 million on July 1st, and then on December the 31st, the fund is worth $110 million. Okay, so we can't because there's this cash flow of the $5 million. We're going to calculate a time-weighted return, and so to compare the performance of one fund from 1 year with that from the next year, to compare the performance of one fund with that of another fund, requires that the returns be measured on a consistent basis over time and across fund managers. So in 1999, a set of voluntary investment performance standards was proposed for this by the CFA Institute. Fund management groups around the globe have adopted the Global Investment Performance Standards, the GIPS. The time-weighted rates of returns method is required by the GIP standards because this measure is not distorted by cash inflows and outflows. So that's why you need to learn it. So how we calculate it, we're going to break the return into two periods, holding period 1, January to June, that because the cash flow was put in on July the 1st, so we calculate the second holding period return, which is July to December. So calculating the holding period return 1, ending minus beginning divided by beginning, negative 2%. Ending 98 million minus beginning, 100 million, divided by beginning, 100 million, negative 2%. Holding period return 2, ending is that 110 million, but the beginning is not 98 million, it's the 98 million plus the 5 million that was put in on July 1st. So that's 110 minus 103 divided by 103. Okay, just bring up the calculator. Ending 110 minus beginning, which is 98 plus 5, 103, divided by the beginning, 103. And you can see 6.796. They've rounded it to 6.8%. So the arithmetic return, minus 2% plus 6.8 equals 4.8. However, to calculate the time-weighted returns, we use the geometric mean rates of returns. And here I have the formula, which we see in the chapter on quants. The geometric return is 1 plus return 1 times 1 plus return 2 minus 1. So you can see here the compounded return, 1 plus, but it was negative 2. So 1 minus 0.02 times 1 plus return 2, 0.068 minus 1 equals 4.66. So let's just see that. 0.98 times 1.068. We minus the 1. Multiply by 100 to get a nice round number, and you can see 4.664%. Okay, so the time-weighted return is a geometric mean rate of return, and we calculate that by breaking the returns up into different segments. The segment is determined by the timing of the cash flows. So holding period 1, 1st of January to June 30th. Holding period 2, 1st of July to December 31st. Calculate the holding period return for each period, ending minus beginning divided by beginning. Don't forget the cash flows, ending minus beginning divided by beginning. And then we calculate the geometric return, 1 plus return 1 times 1 plus return 2 minus 1. Okay? Moving on now to learning outcome statement D, describe measures of risk, including standard deviation and downside deviation. Okay, we studied standard deviation before, but now we're just going to add on looking a little bit at what is downside deviation. So now we're looking at adjusting returns for risk. The previous slide, the previous learning outcome statement, was calculating a holding period returns and time-weighted returns, okay? But now we want to adjust those returns for risk to analyze them, because investors want to get as much return as possible for as little risk as possible. So if two investments have a holding period return of 10%, but the first investment has very little risk, whereas the second one is very risky, the first investment will be better than the second one on a risk-adjusted basis. So as discussed in the risk management chapter, risk can take different forms. The risk we refer to in this chapter is investment risk. So we're looking again at measures of risk, standard deviation. Investment risk is often measured using some measure of variability or volatility of returns, and a common measure of variability is the standard deviation. The standard deviation of returns reflects the variability of returns around the mean or average return. The higher the standard deviation of returns, the higher variability or volatility of returns, and the higher the risk. There are at least two reasons why investors care about historical variability, the standard deviation of past returns. First, past variability of returns might be indicative of how variable returns may be in the future. So the future is not always going to be exactly as the past, but however, in terms of stock market returns, past volatility may be indicative of what the future may bring. But it's important to be aware that volatility may change over time and that there's no guarantee that future returns will behave like past returns. Second, the variability of returns may affect an investor's objectives. Pension funds invest their funds to generate the returns necessary to pay their beneficiaries. Insurance companies invest to generate returns to meet the claims on their policies. Individuals invest because they usually have a future expenditure in mind. So we saw a lot of this in the chapters for investor needs and investment management. So you can see again there starts to be overlap, okay? So investors care about variability. First, the past might give us some insight to the future, and second, understanding that variability affects our objectives, okay? So investing in a portfolio or fund whose returns are vary significantly over time could potentially disrupt an investor's plans. If returns are very negative one year, then the investor's commitments, such as paying pensions, may be harder to meet. Retail investors may need to sell some of their investments because of unforeseen circumstances, such as the decline in dividend income. Okay, so again, here's the formula for standard deviation. We've covered it in the quant. That's different nomenclatures. You can see standard deviation is the square root of variance, and variance is the sum of return minus expected return squared. And if it's divided by n for a population, or n minus 1 for a sample. I know the text is quite often using n, but actually if we're looking at this example in the textbook, where examples 1A and 1B look at these portfolios, 4 equity, 3 bond, and 2 commercial property portfolios. They show the returns first in Exhibit 1A and 1B, then we see the standard deviations, okay? You can see those returns, though, that's a sample return. So often the text is using n, but if it's a sample return, we should be using n minus 1. But anyhow, at the end of the day, standard deviation is the square root of variance. Now we're moving on to the last part of the learning outcome statement, describe measures of risk, including standard deviation. And now we're going to look at the downside deviation, okay? So psychologists and economists have discovered that investors dislike losses more than they like equivalent gains. So investors might be happy about achieving an investment return of plus 10%, but very unhappy about achieving a return of negative 10%. Because of this asymmetry in the way investors view the dispersion around the average, some investment professionals use a modified version of standard deviation known as downside deviation. Downside deviation is calculated in almost exactly the same way as standard deviation, but instead of using all the deviations from the mean, positive and negative, downside deviation is calculated using only negative deviations. Downside deviation, similar calculation as standard deviation, but we use the deviations only on the downside. Downside deviation may also be calculated by focusing on outcomes that are less than a specified return target. This target does not have to be the mean. Learning outcome statement E is describe reward to risk ratios, including the Sharpe and Trainer ratios, okay? So reward to risk ratios. Investors prefer to achieve a high return rather than a low return on their investment portfolios. That makes sense. So all things being equal, they also prefer lower risk, less variability of returns. In other words, investors are interested in maximizing the return on their investment while simultaneously trying to minimize the risks. That is, they prefer investments that have a high return per unit of risk, investments with a high reward to risk ratio. So here you can see the reward to risk ratio is the measure of the portfolio return. And we've seen this before in the chapter on investment management. We talked a little bit when we looked at JP Morgan asset class returns. And so we're looking at the return of the asset class or the portfolio relative to the risk. And we've seen that before, that's a pretty good, we're looking for a high reward to risk ratio. And the portfolio had a much better reward to risk ratio than the small cap stocks. The small cap stocks had a higher return, but they were very much more risky. So we've seen a little bit of this before, but now we're just going to expand on it and include the Sharpe and Trainer ratios. And so I'm just starting this LOS with all three ratios on the same slide. You can see they're very similar in a lot of cases. So the reward to risk ratio, return of the portfolio divided by the standard deviation of the portfolio. The Sharpe ratio, we still have the return to the portfolio in the numerator and the standard deviation of the portfolio in the denominator, but we're simply subtracting the risk-free rate. So in the numerator, it's the return of the portfolio minus the risk-free rate divided by the standard deviation of the portfolio, and that's how we get the Sharpe ratio. The Trainer ratio, however, is introducing a new concept that we haven't looked at in really any detail in any of the chapters, is the concept of beta. When we move on to the Trainer ratio, you can see that the numerator is exactly the same as the Sharpe ratio. The numerator is return to the portfolio minus the risk-free rate. But instead of dividing by the standard deviation of the portfolio, we're going to divide by the beta of the portfolio. And we're going to look at how to calculate a beta, as a nice to know, not a need to know, just because it's covered in this chapter. Okay. Now we're moving on to the Sharpe ratio. The Sharpe ratio, first suggested by Nobel Prize winning economist William Sharpe, is a commonly used reward to risk ratio. The portfolio reward is measured as the portfolio's excess return, which is equal to the difference between the portfolio's holding period return and the return on a risk-free investment. The risk-free investment is usually approximated by the return achieved from investing in short-term government bonds, because in most countries, government bonds are the investments that carry the lowest level of risk. The portfolio risk is the standard deviation of portfolio returns. So the Sharpe ratio, as I've shown you, is the return on the portfolio minus the risk-free rate divided by the standard deviation of portfolio returns. The Sharpe ratio, along with other reward to risk ratios, is an important metric for understanding the quality of the returns produced by a portfolio. A portfolio with high returns but also high risk might be said to have produced lower quality returns than a portfolio with similarly higher returns but with much lower risk. So in a sense, reward to risk ratios such as the Sharpe ratio are one of the main quality control checks that investors need to make on their investments. Such ratios are also helpful for comparing investment choices. So here we're looking at an example where the portfolio return is 10%, the risk-free rate is 4%, the standard deviation of the portfolio is 5%. So we're going to see later on the beta is 1.8. We're not using that to calculate the Sharpe ratio. We're going to use that to calculate the Trainer, but this is the portfolio. Okay, so to calculate the Sharpe ratio, it's the portfolio return 10% minus the 4% risk-free divided by the 5%, and we get a Sharpe ratio of 1.2. The higher the Sharpe ratio, the better. So we might compare that to another portfolio that had a 10% return. So again, we can't compare not only the returns but also the risk. So we say, oh, that's a pretty good portfolio, return 10%. But if we could calculate historical risk as being much higher, it's going to have a lower Sharpe ratio. We're going to choose the more efficient portfolio. So now we're moving on to the Trainer ratio. So we're assuming when we do our calculations the same portfolio, but now we're going to use the beta of 1.8. Okay, so pay attention to that. The Trainer ratio is another commonly used reward to risk ratio that was suggested by Jack Trainer. The measure of portfolio reward is the same as that used in the Sharpe ratio, but the measure of portfolio risk is different. So you can see the numerator is the same, the Sharpe ratio and the Trainer ratio, which is the return to the portfolio minus the risk-free rate. But in the Sharpe portfolio, the denominator is the standard deviation of the portfolio, but in the Trainer ratio, the denominator, the risk measure is the beta of the portfolio. In this portfolio, the beta is 1.8. I'm going to give a couple of minutes on nice to know, not need to know, but we're going to look at actually how you calculate a beta. It's basically the return of the stock or the portfolio relative to the return to the market. The market return is assumed to have a beta of 1, so we compare our returns relative to the market, basically. So it's another measurement of risk. So the Trainer ratio, same numerator, return to the portfolio minus risk-free rate. But the denominator, we're going to use the beta. So here we can see we calculated the Trainer ratio as 3.33. Okay, Sharpe ratio uses standard deviation. Trainer ratio uses beta, which is a measure of the portfolio's systematic risk or market risk. A quick practice question to check your understanding. This is at the expert level from the learning ecosystem. And the question is, a portfolio manager invests in large cap U.S. common stocks, such as those found in the S&P 500 index. Which of the following is the worst measure of the manager's performance? A, the average risk-adjusted return of the portfolio over the last 5 years minus the average risk-adjusted return of the S&P 500 index over the same period. B, the Sharpe ratio of the portfolio calculated using the last 5 years returns relative to the Sharpe ratios of other large cap stock portfolios over the same period. Or C, the standard deviation of the portfolio returns over the last 5 years relative to the standard deviations of other large cap stock portfolios over the same period. So the correct answer is C. The worst measure of the manager's performance is C. Standard deviation is a measure of risk, but it does not consider return. The portfolio might have had less risk than the S&P 500, which is a good thing, but it also may have lower returns, which is a bad thing. Risk alone is not a good indication of performance. So in both A and B, they were incorrect. They were better measures of the manager's performance because in A, you're using risk-adjusted returns, and in B, you're using the Sharpe ratio, which is a risk-adjusted return, because you're looking at the excess portfolio return of the portfolio minus the risk-free rate, and you're dividing by the portfolio standard deviation, okay? But in C, you're only comparing the standard deviation of the portfolio versus the standard deviation of other large caps. You're not risk-adjusting the returns. Okay, this part of the video is a nice to know. It's not a need to know. I'm just going to go through very quickly because we're looking in the trainer ratio that for the trainer ratio, it was the return of the portfolio minus the risk-free rate divided by the beta of the portfolio, but we haven't really covered in any detail what a beta is. So we can calculate the beta for a portfolio versus the benchmark index, or we could calculate the beta of a stock, okay? So it's a security return, could be a stock or a portfolio. And basically, on the y-axis, you've got the security return, and on the x-axis, you've got the market return. And calculating a beta basically is y is dependent on x. So the security return is dependent on the return of the market, which is the systematic risk. And so beta is just the slope. The formula is y, the return of the security, equals a, an intercept, plus beta times x. X is the market return. So beta is just the slope of this line, okay? So the formula to calculate a beta is to divide the covariance of the asset and the market by the variance of the market. So beta equals the covariance divided by the variance. And we learned how to calculate covariance in the Chapter 8 on quantitative concepts. And also we learned variance in Chapter 8 as well. This is a sample variance, and we understand that the standard deviation is the square root of the variance, okay? So again, this is a nice to know, not a need to know, but remember we also studied correlation because we're looking at the JP Asset Morgan returns, and we're looking at the correlation returns. Correlation equals covariance divided by standard deviation of x times standard deviation of y. So just doing a little bit of rearranging, we know that covariance equals correlation of x and y times standard deviation of x times standard deviation of y. And we use this when we calculated portfolio standard deviation. You can see how it's coming together. This is why I want to go through very quickly how to calculate a beta, because we've done a lot of the math. The beta for an asset is the covariance divided by the variance of the market. Covariance between the asset and the market divided by the variance of the market. We've learned those calculations. And again, we looked at the standard deviation of the portfolio. Expected return for a portfolio is the weighted average, but when we looked at portfolio standard deviation, it's not the weighted average unless the correlation was 1. Any two-asset portfolio with a correlation of less than 1, standard deviation is going to come down because we included covariance in the formula for portfolio standard deviation, which we then converted into this form, and we could see that correlation going between -1 to +1, and any value less than +1 resulted in smaller portfolio deviation. So we've seen that before, okay? So then in terms of the variance here of the market, we could also write that the variance of the market equals standard deviation of x times standard deviation of x. So then we could adjust the beta formula beta, and so in the numerator, the covariance, we're now using this form, and on the denominator, we're expanding it, so we can see beta equals correlation times standard deviation of x times standard deviation of y divided by standard deviation of x times standard deviation of x. So you can see what we're going to do on the next slide is we're going to cancel those two standard deviations out. So here I am, just the formula from the previous slide, but to save some space, simplifying the algebra by crossing out one variance of the market in the numerator against one variance of the market in the denominator, we're left with this formula, which is beta equals correlation of x and y times standard deviation of y divided by standard deviation of x. But that becomes that's a very common use formula for beta when it's rearranged. So beta equals correlation of x and y times standard deviation of the y divided by the standard deviation of x, and remember x is the market, or we could see beta equals covariance of x and y divided by the variance of x. Okay, so I just went through that step by step. That's a nice to know, not a need to know, but you often see beta as two different formulas, and that was just how we get to it. Okay, so next we're going to look at an example of calculating the beta for General Electric, and the steps are, number one, we're going to calculate the average return for the stock. We're going to calculate the average return for the index. We're going to calculate the covariance. We're going to calculate the variance of the market, and the beta is the covariance of the stock in the market divided by the variance of the market. Okay? So I'm going to run through how to calculate the beta, and this is an example from the textbook Investment Analysis and Portfolio Management by Riley and Brown. This is the textbook that I had to use when I did CFA Level 1 back in 2001. Level 2 I used 2002. Level 3 I wrote in 2003. Passed all 3 exams on first attempt. Allowed to say that, but ethically not allowed to say that it makes me very smart. Anyhow, moving on. The reason why I'm saying that is I used the Riley Brown textbook back in 2001, and in the textbook they had how to calculate the beta in an appendix, but it was actually looking at Coca-Cola versus the S&P 500. Then the textbook was updated to GE, and you can see they're looking at 2004, so still quite a while ago. And this reading is no longer in the CFA curriculum, but I still like to use it because we run through the steps to how to calculate a beta. It takes us through all the math that we've learned in the quant, and you say, okay, that's great. And we're going to use that beta in Cap M. So it's a foundation of a lot that we do in CFA Level 1. Because the trainer ratio is mentioning the beta, I just thought we'd run through it because it's quite easy and it's using all the math that we're just building on that we learned in the quantitative concepts. Anyhow, so we have the dates here. This is monthly returns. We're looking at the closing price of the stock, and we're looking at the closing index level of the S&P 500. So it's monthly, December 2003, then January 04 to December 2004. So you can see we have 13 months, but we have 12 returns. So step one, we can record the closing price. That's just observable, and it's important to note that there was no dividends paid during this time period of data that we're looking at. So the rate of return is just the ending minus the beginning divided by beginning. So step number one, we calculate the rate of return, ending minus beginning divided by beginning, and then we can calculate the average return is the sum of the returns divided by the number of returns. So we had 13 months, but 12 months of data. And so we got an average return of 1.45% on GE. So we're just going to do the same thing for the S&P 500. We're going to look at the closing prices, and we can calculate the rate of return, ending minus beginning divided by beginning, and we get the rate of return. And we can calculate the average return, or sometimes we use expected return in finance speak, so just don't get confused. That's why I put average here and expected over there. Anyhow, the average return was 0.74. So that's step one. Collect your data, calculate the returns. Then step number two, because we want to calculate the variances, we're going to, how do we calculate the variance? It's the sum of return minus average return squared. So in this column here, I've got my return minus expected return, and this column I've got my return minus expected return squared, okay, which would just be 7.11 times 7.11 gives you 50.5. So how do I calculate the variance? It's the sum of my returns minus expected returns divided by n minus 1, and the standard deviation is the square root of the variance, okay? So again, I'm just going to do that first for GE, and I'm also going to do that for the S&P 500. And then I can calculate my covariance. Remember, my covariance is the sum of x minus x bar times y minus y bar divided by n minus 1. So in this column, I've got my x minus x bar times my y minus y bar, and I said that's multiplying column 1 times column 2 that I highlighted with the pink numbers. Okay, so that's where that data is coming from. 7.11 times 0.99 gives us 7.02, and the covariance is the sum of that column divided by n minus 1. So you can see to calculate the variance, or to calculate the covariance, it's all really quite simple if you map it out with a quick little example comparing GE versus S&P 500. We just needed the closing prices, and we could calculate the returns. Return minus average return, square that, sum it, divided by n minus 1. You've got the variance, square root of that, you've got the standard deviation, okay? And then therefore the beta is the covariance of the asset, the stock in the market, divided by the variance of the market. So here we had the variance of the market, 4.38. Covariance divided by variance gives us a beta of 0.89. And remember, that is a slope on a curve. Y is dependent on x. Y equals a plus bx. And the beta is the slope of the line. The security return is dependent on the return of the market. So just very quickly, you can see I put this in Excel. So the only hard-coded data is the prices that we need to observe and input. And so then to calculate the return, it's simply, you can see from my formulas, ending minus beginning divided by beginning times 100. That's really easy. 33.63 minus 30.98 divided by 30.98 gives us our 8.55. So I do that for all the returns, and then I'm going to sum up the returns, and then I'm going to get the average, which is the sum of the returns divided by the number of returns. There's 12 returns, okay? Then in the next column, what I'm going to do is I multiply the return minus the, I subtract it's y minus y bar, the return minus the expected return. So 8.55 minus 1.45 gives us 7.11. We need that because when we calculate the covariance, it's y minus y bar times x minus x bar, and that gives us this column. We sum that up, and the covariance is the sum of y minus y bar times x minus x bar divided by n minus 1, because we're using, again, a sample, okay? So not too difficult. You can see for my y minus y bar squared, it's just E4 times E4, just 7.11 times 7.11. Sum up the sum of y minus y bar squared divided by n minus 1 gives us our variance. Square root of the variance gives us our standard deviation, okay? So again, the beta of a portfolio is the covariance divided by the variance, okay? But again, if I just scroll it over my spreadsheet, you can see I've taken here the rate of return data for Y is the market, X is the stock, and what I can do is I can go to data. So I can go to my data analysis tool pack, and I can run the regression. So the Y data, that's the here, if I want to click on the Y, that's going to be the stock data, and the X is the Y depends on X. X is the market data. Okay, and I'm just going to click OK. It's going to run the regression. Just let me move this over so that you can see it. And lo and behold, running a regression on the return of the market versus the return of the stock, or the return of the stock versus the return of the market, the beta is 0.89. Okay, so again, we looked at it, how to calculate a beta using algebra, covariance divided by covariance of the stock in the market divided by the variance of the market. Or we also looked at, it's just a regression of the returns, so we just had to calculate the returns of GE versus the returns of the S&P 500, run a regression, y is dependent on x, and the slope, y equals a plus bx, that slope is 0.89. Okay, looking back, I see we spent about 15 minutes on how to calculate a beta. That was a nice to know, not a need to know. But I think for some of you, you'll appreciate that, and you'll say, okay, I got it, because we're using all the math that we build on in quantitative concepts And really, it's not all that difficult if you get walked through an example like that, and it really starts to gel all the math and why you had to study the math, okay? So all starting to make sense to you now. Anyhow, we're going to move on to Learning Outcome Statement F, which is describe uses of benchmarks and explain the selection of a benchmark. By measuring relative returns, that is, returns relative to a suitable benchmark, investors can determine whether they could have made more money in other investments. Measuring relative returns allows them to assess their opportunity cost and determine whether their investments are generating appropriate returns. The calculation of a reward-to-risk ratio, such as a Sharpe ratio, allows investors to compare the performance of one investment fund with that of another. Many investors also want to compare the performance of their fund or portfolio with that of a financial market benchmark, such as a stock index. Benchmarks can be used to assess the quality and/or quantity of a company's performance by comparing its performance with that of its peers and competitors. An application of this use of comparison was in the financial statements chapter with ratio analysis. So now we're continuing with the uses of benchmarks. Fund managers may not only use a benchmark for assessment, but some, such as index fund managers, may also manage their portfolios to a benchmark. So we saw that in the chapter on investments, exchange-traded funds, pooled investments, mutual funds that trade on an exchange, and they're meant to replicate an index, okay? So this means that the manager must regularly compare the composition and performance of the portfolio with a comparison of a financial market index, such as the FTSE 100 index or the S&P 500. For investors, knowing the financial market index that a fund manager uses as a benchmark will give them some idea of the return and risk that they can expect from investing in that fund. Before engaging a fund manager, institutional investors will often specify the financial market benchmark that they intend to use to assess the performance of the fund manager. For example, a U.S. equity fund manager may be asked or mandated to manage a portfolio of U.S. equities for a client and told that they'll be benchmarked against the S&P 500. Alternatively, a manager might be given a specific mandate reflecting specific risk requirements, return requirements, or style or sector preferences, such as investing in biotech companies. In this case, simply holding the 500 U.S. stocks that make up the S&P 500 in their appropriate proportions will not produce the performance demanded and paid for by clients. To beat this benchmark, the manager will have to be an active manager and to use analytical and trading skills and deliver high levels of client service to satisfy the mandate. Now we're looking at the criteria for selecting a benchmark. A financial benchmark must meet certain criteria. Number one is investability. The benchmark should be composed of assets that can be bought and sold by the fund manager. For passive fund managers, it would be difficult to mimic the benchmark if it contained assets that they could not buy. For active fund managers, not being able to invest in some of the benchmark's components could limit the ability to outperform it. Number two is compatibility. The benchmark should have an appropriate composition and level of risk for the investor. In other words, it should match the investor's objectives. Number three is clarity. The rules governing the construction of the benchmark should be clear. This clarity should extend to the weighting of individual benchmark constituents, to the method used to calculate benchmark returns, and to the process used to add and remove constituents to and from the benchmark over time. And finally, number four, the fourth criteria for selecting a benchmark is pre-specification. The benchmark should be specified before an investment is made so that the manager is clear about the client's objectives and expectations, and so the manager can construct a portfolio accordingly. A quick question from the ecosystem at the expert level, and the question is, an investor's portfolio is managed to a custom benchmark for emerging market equities that uses complex methods for weighting various countries in the benchmark and calculating benchmark returns. These methods are well defined and can be found on the portfolio manager's website. These facts suggest that the benchmark meets which of the following criteria? A, clarity, B, compatibility, or C, pre-specification. Okay, the correct answer is A. A is correct. A benchmark meets the clarity criteria if the rules governing its construction are clear and unambiguous. For B, when we're talking about compatibility, a benchmark meets the compatibility criterion if it's appropriate to the investor's needs and desires. So We have to always be careful with the language. Compatibility is you have to be looking for the word investors' needs and desires. And for C, pre-specification, a benchmark meets the pre-specification criterion if it's specified in advance. Moving on now to learning outcome statement G, which is explain measures of relative performance, including tracking error and the information ratio. So the tracking error of an investment fund reflects how the performance of the investment fund deviates from the performance of its benchmark. The tracking error is measured by taking the standard deviation of the differences between the returns on the fund and the returns on its benchmark. The bigger these differences are, the larger the tracking error is. A passive fund manager may be expected to have a very low tracking error because the manager is seeking to replicate a benchmark. But for an active manager, the tracking error will be higher. Tracking error can also be used to formulate another very popular reward to risk ratio known as the information ratio. The reward part of the information ratio is the difference between the holding period return on the portfolio and the return on an appropriate benchmark over the same time. We call that the alpha. The risk part of the information ratio is based on the tracking error of the fund, that is, its deviations from the performance of the benchmark. So the information ratio equals the difference between the holding period return on the portfolio and the return on the benchmark, which is alpha, divided by the tracking error of the fund. Okay? If the information ratio is negative, the fund underperformed its benchmark over the period. If it's positive, it outperformed its benchmark. So we can see in the numerator is the average of the periodic differences, and the denominator is the tracking error of the fund. And so, of course, if the return of the portfolio minus the benchmark, that's the periodic differences. If it's negative, if the fund is underperformed, the numerator is going to be negative. The information ratio is going to be a negative number. Okay, this is a nice to know. It's not a need to know, but I took that data from the textbook and I put it into my Excel sheet again. And I just wanted to show you that that tracking error is the standard deviation of the the average deviations. So I just wanted to walk you through it. It's the same thing. Just because we did the math for calculating the beta, etc., we calculated the variance and the standard deviation. I want to show you that to calculate the information ratio, which is the average deviation divided by the tracking error, to get that tracking error, we're actually calculating a standard deviation. So I just wanted to show you. So here we are with the table. We had 10 years of data. We had the equity portfolio total returns. So we had the benchmark returns. So we calculated the difference, and that's my RT. That's the difference. And so then we could calculate the average deviations. Okay. So then this column, the difference minus the average deviation. So we could see negative 0.05% minus a negative 0.45%. So that would become a positive. We've got 0.4%. And then if we square that, we've got this column, okay? So remember, the variance is the sum of the return minus, average, is what we did with the beta, but in this case, it's the difference in the deviations minus the average difference in deviations. We square that, divided by n in this case. They're using a population formula. I just want to point that out. And so then we take the square root, we get the standard deviation. Mine, because I've put into Excel just a little bit of rounding, you can see I've calculated the tracking error as 0.83%. So the average deviation divided by the tracking error gives us our information ratio. Okay, so I just wanted to show you again. They gave you that tracking error in the text, and they explain it a little bit that it's the standard deviation of the average deviation. So I just thought by taking a minute and putting it into a spreadsheet, much like we saw how to calculate the beta. This column for calculating the beta was the security returns. In this case, it's the difference in returns. We have the difference in returns minus the average deviations returns. We square it, sum it up, divided by n. That gives us our variance. Square root of the variance is our standard deviation. That's our tracking error. Average deviation divided by our tracking error gives us our information ratio. I did that that spreadsheet. I just want to show you, the better you understand the math, you're not responsible for memorizing the formulas or doing calculations, but the better you understand the math, it makes it a lot easier to answer the word-based questions based on the math, okay? And that's why I just always try to do a little bit extra, just so that you're better understanding, the better you are for answering these expert-type questions. So here's a question from the learning ecosystem at the expert level. A fund manager's portfolio has a negative information ratio for the most recent 5-year period. The negative information ratio can be attributed to A, a negative fund tracking error, B, a high portfolio standard deviation, or C, the fund underperforming its benchmark. Okay, you can see here the fund manager has a negative information ratio, and remember, that's because the fund is underperforming its benchmark. The formula for information ratio is the average of the periodic differences. That's looking at the alpha, and alpha can be either positive or negative. You can have a negative alpha, but it's being divided by, it's the average periodic differences divided by the tracking error of the fund, and the tracking error of the fund is the standard deviation of those periodic differences, and that can't be negative, okay? So C is correct. The information ratio is calculated by dividing the difference in average returns between the portfolio and the benchmark by the portfolio tracking error. The numerator is positive if the portfolio outperforms the benchmark, and negative if it underperforms the benchmark. The tracking error is the standard deviation of the differences between the portfolio and the benchmark. Tracking error cannot have a negative value, okay? Information ratio can be negative, but tracking error cannot be negative, so you just want to be careful with that. So as I said, I just cut and paste. Information ratio equals the average of the periodic differences divided by the tracking error of the fund. Information ratio is negative, fund outperformed. The benchmark, if it's positive, it outperformed. Another quick question at the expert level to check our understanding. The question is, if a portfolio's tracking error increases, its information ratio will A, grow larger, B, not be affected, or C, move closer to zero. Okay, again, that's why the importance of understanding the formula, what's in the numerator, what's in the denominator, makes this English question based on the math a lot easier, because it's saying if a portfolio's tracking error increases. So remember, the information ratio in the numerator is the average of the periodic differences, but the denominator is the tracking error of the fund. The tracking error cannot be negative, but the numerator can be negative because the average of the periodic differences between the fund and the benchmark, of course, it can be negative or it can be positive. Anyhow, this is talking about if a portfolio's tracking error increases. So we are increasing the denominator. When we increase the denominator, we're going to decrease the information ratio. Increase the tracking error, increase the denominator, decrease the information ratio. Okay? A decrease in a number. So this is just a little tricky thing, though, because a decrease in a number, it would grow smaller, but that's also moving closer to zero. So I think they're being a little bit cheeky with their English. Do you understand that? So it says most likely will move closer to zero. That's the same thing as saying is it will grow smaller. Okay, so you just want to be a little bit careful with the English that they've used in this question. That's why I like this one at the expert level. A, put the question, write out the formula. B, understand the numerator and denominator. Look at it, arrow up on your, on the tracking error increases. It's going to decrease the information ratio, which is moving it close to zero or reducing it. So you can see it's a language game. I would look on the exam for a question where it's if a portfolio tracking error decreases, the information ratio will increase. Again, this is a classic CFA type question. You've got three variables. Given a change in one, what's the outcome on another? Or given two, sometimes when you move up to the CFA, calculate the third. Okay, so just remember, increase the denominator, decrease the information ratio, and that a number decreasing does move it closer to zero. So it's just a funny little thing on the language. It's growing smaller. The information ratio is growing smaller. It's moving closer to zero. It's decreasing. Learning outcome statement H is explaining the concept of alpha, okay? So we're looking at alpha versus beta versus luck. So the calculation and analysis of reward to risk ratios allow an understanding of the price fund investors have to pay in terms of unit of reward for each unit of risk, the total return generated by the fund's managers. All other things being equal, a manager who produces consistently high reward to risk ratio could be said to be more skillful than one who consistently produces a much lower ratio. Investors who invest in a fund that is managed on an active rather than on a passive basis are effectively paying for the manager's investment skill and expertise. Fund manager skill is often referred to as fund manager alpha. Perhaps the best way to explain the concept of alpha is to consider the source of any fund's return, which may be composed of varying amounts of the following three elements. 1. Market return. 2. Luck. And 3. Skill. In terms of market return, the manager of a passive investment fund will produce returns for investors. They typically buy and hold these securities that comprise their benchmark in the appropriate proportions. Although this process requires some skill, it is not really investment skill. Over time, the fund should produce a return similar to that of the chosen benchmark, minus fees. Given that most active managers benchmark their funds against financial market indices, such as the S&P 500, some of the return generated by an actively managed fund will be caused by broad market movements over which the active fund manager has no control. Arguably, then, the investors in actively managed funds should not pay higher active fees for fund returns that are generated by the market rather than by the investment acumen of their fund managers, because they can access market returns at a cheaper price by investing in passively managed funds. Now we're moving on to luck and skill. Luck. Some of the return generated by an investment fund will be the result of luck rather than judgment. As we saw with the JP Morgan Guide to the Markets asset class checkerboard, showing the returns of various asset classes from 2003 to 2017, we saw that the prices of financial assets held in portfolios are very volatile, and they are affected by many events that cannot be foreseen by a fund manager. Skillful fund managers may be unlucky on occasion, and unskilled fund managers may enjoy some good luck. Because luck will tend to even out over the long term, it's vital that investors are able to distinguish luck from skill. However, it's not always easy to do so, especially not in the short run. Skill. A skillful fund manager is able to add value to a portfolio over and above changes in the portfolio's value that are driven by broad market movements that could have been produced by a passive fund manager. Because luck will tend to even out over time, a skillful manager is one who adds this value consistently over time, year after year. This outperformance over the return of a relevant market benchmark is generally referred to as alpha. So it's the difference between the portfolio return, the benchmark return. We call that alpha. Alpha can be positive, is overperformance. Alpha can be negative, that is underperformance. Now we're going to look at distinguishing between sources of return. Performance evaluators try to distinguish between these three sources of fund management return using factor models to determine the factors that make up returns and the importance of each factor. One such model is the capital asset pricing model, CAPM, from which comes the term alpha. This model also gave rise to a measure of systematic risk, also called market risk or non-diversifiable risk, which is the beta. Factor models such as the CAPM separate the fund's performance into return from market performance, beta, from luck or randomness, or from the investment skills of the fund manager, alpha. Finally, alpha is calculated by using factor models in an effort to identify the return contributions from a fund manager's skill. Okay, this is a nice to know. It's not a need to know. The previous slide mentioned CAPM. Thought I'd just quickly explain it. So CAPM, capital asset pricing model, basically what it is that the required return for a security like a stock is the risk-free rate plus the beta times the expected return of the market minus the risk-free rate. We call that the market risk premium. So you can see this is the required rate of return of a stock, or it could be a portfolio as well. Risk-free rate plus the beta of the stock or the portfolio times the market risk premium, okay? So how did that formula come from? Well, we're going to look at a graph here, a return to risk graph, but here instead of standard deviation, we've changed it to beta. And then, so we can draw a line that starts at the risk-free rate. Expected return is the risk-free rate here, so that's why it starts on the axis. And then we have a slope of this security market line. Okay, so we're going to start with the case where the expected return of the stock equals the expected return of the market, and the beta of the stock equals the beta of the market at 1. So we're at this point right here, okay? So we could write the formula, expected return of the market minus the risk-free, at that point is also equal to the expected return of the stock minus the risk-free. And we divide the beta, divided by the beta of the market or the stock, they're both 1. So what we could do here is we could multiply both sides by the beta for the stock. So on the left-hand side, we've got the beta of the stock times that formula. On the right-hand side, we've got the formula times the beta of the stock. So we can scratch it out using the algebra. We rearranged the algebra to move the risk-free. So now you can see that we've got risk-free plus the beta of the stock times expected return of the market minus risk-free. We changed the beta of the market to 1 equals the expected or required return of the stock. So just rearranging it then, expected or required return of the stock equals the risk-free plus the beta times the market risk premium. That's the market risk premium right here, folks. That's the expected return of the market, and that's the risk-free rate. So expected return of the market minus the risk-free rate, that's the market risk premium. Okay, so that's the CAPM in 2 minutes and 22 seconds. So the reason why I wanted to spend a bit of time on that previous slide is that there's another measurement that's not mentioned in the text. We looked at return to risk, then we looked at the Sharpe ratio, then we looked at the trainer ratio. But in CFA level 1, there's also the Jensen's alpha. And you can see the Jensen's alpha, again alpha, so that's going to be overperformance or underperformance, is the return of the portfolio minus here. You can see the risk-free rate plus the beta, and that could be the beta of a portfolio, it doesn't have to be a stock, times the market risk differential, okay? So you can see again, that would be the required return for that portfolio. You can calculate that. So you're going to compare the required return versus the actual return, and that's going to be negative or positive. If it's positive, then the fund manager is adding value. And you can see here, like the trainer ratio, remember the trainer ratio is return to the portfolio minus the risk-free divided by the beta, okay? That was the trainer. So the beta, that's the systematic risk, and here you're also getting it in the Jensen's alpha. So like the trainer ratio, Jensen's alpha is based on systematic risk. Just Jensen's alpha, also vertical distance from the security market line, measuring the excess return for the same risk as that of the market. Okay, this is a nice to know, not a need to know, but it did mention the CAPM, and it's also, it introduced the concept of another performance evaluation using the Jensen's alpha, which is the return to the portfolio, minus the formula for CAPM, which is the required return for the portfolio. And you can see very closely related to the trainer, the difference between return of the portfolio minus risk-free rate divided by the beta of the portfolio, which is systematic risk. So a quick practice question from the learning ecosystem classified at expert. The question is, the return a fund earns from market performance rather than the fund manager's skill is referred to as A, beta, B, alpha, or C, holding period return. And the correct answer is A. A is correct. The return of a portfolio can be divided into the part coming from the manager's skill, known as alpha, the part coming from market performance, known as beta, and the part coming from luck. So you can see the return the fund earns from market performance rather than skill or luck, that's the beta, okay? Alpha is the part of the portfolio return that comes from skill, and holding period return, well, we saw that before. The holding period return is just the total return from all sources, ending minus beginning plus income divided by the beginning. So now we're down to the last learning outcome statement I, which is explain uses of a performance attribution, okay? Attributing performance. So benchmarks form the basis of performance measurement, which is an important part of performance evaluation. By comparing the performance of a UK equity fund manager with the performance of an appropriate UK equity index, the fund manager's clients can get an idea of how well the fund manager is performing relative to the market in general, both in terms of average return and in terms of risk by calculating the fund's tracking error or information ratio. Benchmarks can also be used to further explore the reasons for the fund's manager's performance. By using appropriate financial market indices, the fund manager's performance can be decomposed to reveal the sources of the return. Depending on the nature of the fund, the performance itself might come from the following sources. Number 1, asset allocation. Number 2, sector selection. Number 3, stock selection. And number 4, currency exposure. All those 4 factors can contribute to performance. So, we want to attribute the performance to the different factors, okay? Knowing where the fund manager's performance was derived from is useful information both for the clients of the fund and for the investment management company. For example, if a fund manager is good at stock selection but less proficient at sector selection, another fund manager may be asked to give advice on the sector selection aspect of the portfolio, allowing the original fund manager to concentrate on stock selection. Knowing the strengths of the fund manager performance can also help investors choose an investment fund. Determining how much of performance is the result of the selection of the best performing asset classes, sectors, individual securities, and currencies is known as performance attribution, and it is the 4th stage of the performance evaluation process. That's a good time to just cycle back and review. Remember the performance evaluation process, 4 steps. Step number 1, measure absolute returns. So we do that with holding period return or time-weighted returns for the funds because of the cash flows. Number 2 is we're going to adjust the returns for risk. So we look at the return to risk ratios. We had the Sharpe ratio, return of the portfolio, minus risk-free rate divided by portfolio standard deviation. We had the Trainer ratio, which had the same numerator, return of the portfolio minus risk-free rate, but we're dividing by the beta. And then also we looked at Jensen's alpha. That's not included in the curriculum. Anyhow, the 3rd step is to then measure the relative returns. So we're measuring relative to the benchmark. We want to see whether we underperformed or outperformed the benchmark. And if we did outperform or underperform the benchmark, the final step is to attribute the performance. The performance of the fund, was it based on asset allocation, sector selection, stock selection, or currency exposure? So we'll compare the factors, those percentages and proportions of the fund versus the benchmarks. We'll decompose the returns, and we can see what's driving, what the performance is attributed to what. So here we're going to work through an example for performance attribution. So we're looking at some benchmark here, some type of custom benchmark, and the benchmark is made up of 60% weighting in the FTSE 100 and a 40% weighting in the S&P 500. So first of all, 60% plus 40%, 100%. That's your benchmark weighting, okay? So during a year or a period of time, the benchmark returns, there was a 10% return to the FTSE 100, and there was an 8% return to the S&P 500. So we can do the weighted average return. 0.6 times 0.1 equals 6%. 0.4 times 0.8 equals 3.2%. 6% plus 3.2% equals a benchmark return of 9.2%. Of course, returns is always the weighted average of the returns. So the benchmark, 60%, FTSE 100, the benchmark had a 10% return, 0.6 times 0.1, 6%. 40% weighting in the S&P 500, 8% return in the S&P 500, 0.4 times 0.8, 0.08 equals 3.2%. Add the weighted, so that gets our weighted average, okay? Now, moving on to the portfolio, you can see the portfolio is underweighted in the FTSE 100. It has a 40% weighting in the FTSE 100. So 0.4 times 0.1 equals a 4% of the return coming from the allocation decision. And it was overweighted in the S&P 500. You can see it's here was 60-40, here is 40-60. 40 plus 60 equals 100. So 60% times the 8%, 0.6 times 0.08 equals 4.8%. Add the two together, and you can see the portfolio weighted return was 8.8%, okay? So therefore, the decision to put more weight in the S&P 500, it reduced the return by 0.4%, because you can see the benchmark return was 9.2%, return to the portfolio 8.8%. So 8.8% return to the portfolio minus the return to the benchmark 9.2, and you can see that it's negative 0.4% underperformance versus the benchmark. Okay, so then what it's saying down here though is if the actual portfolio return was 9.5%, let's say that it's not 8.8, it's 9.5, then there must have been another factor attributing to the difference. So 9.5 divided by 8.8, that gives you 0.7%. Oh, that must come from stock selection. Okay, that would explain the difference. Here's explaining the difference based on the allocation versus the benchmark. And if there is further difference, well, then it has to come from the stock selection. So again, just following from the previous slide, there was a benchmark that is weighted 60% in the FTSE 100, 40% in the S&P 500, but then you had an active portfolio that took a different weighting decision and was weighted 40% in the FTSE 100 and 60% in the S&P 500. And then what happened during the year, the S&P 500 did not do as well as the FTSE 100. The return to the FTSE 100 was 10%, and the return to the S&P 500 was 8%. So if we looked at the return for the benchmark index, it's the weighted average. So 0.6 times 0.1 equals 6%, plus 0.4 times 0.08 equals 3.2%. Benchmark is 9.2%. So from the asset allocation factor, the portfolio, 0.4% times 0.1 equals 4%, 0.6% times 0.08% equals 4.8. Add the two together, 8.8%. So the difference between 9.2 and 8.8, that's the asset allocation return, and that's 8.8. Portfolio return minus benchmark return equals negative 0.4%. Okay, so that's explained. But then, if this is the hypothetical, if the portfolio was 9.5%, it's not being fully explained by the asset, by the benchmark return was the underlying 9.2, and the asset allocation. Has to be another factor, and that's the stock selection return. So you can see if we made that X, it would be 9.5, X equals 9.5 minus 9.2, and then minus, it's a negative 0.4%, so that turns into a positive. So if I just bring up the calculator here, 9.5 minus 9.2 plus 0.4%, and you can see the stock selection return was the 0.7%. So we could solve that for X if we knew it's easier to calculate the portfolio return, and then it's fairly easy to judge see the benchmark return, and then calculating the asset allocation return is fairly easy. And so what's left over must be the stock selection return. By the way, the CFA Institute has an entire program dedicated to performance management. It's called the CIPM program. So the CFA Institute has three major programs: CFA program, Investment Foundations program, which we're looking at the topics right now, and the third program is the CIPM program. So let's just scroll down. You can see register for the exam, etc., smart guides, interview, and you can see they similarly have a learning ecosystem, same as what is being used for the Investment Foundation, same platform. Okay, so just to let you know, there's an entire program dedicated to performance management if that is something that you are interested in. Okay, we're going to finish this video with one last practice question from the expert level. I just always like to say speed is a skill. Skill gets rewarded. How do you get speedier at doing practice questions? Do as many as possible, clear and reset them. You can see this question has a lot of words, a lot of numbers. It might take you a minute to work your way through it. But anyhow, let's see how it goes. So the question is, a fund manager's performance over the past year is being evaluated. The fund manager earned a return of 9% compared with the benchmark return of 10.6%. His portfolio consists of 70% allocation to U.S. large cap stocks, 30% allocation to UK large cap stocks. His benchmark consists of 60% allocation to S&P 500, 40% allocation to FTSE 100. The return over this period was 13% for the S&P 500, 7% for the FTSE 100. If the portfolio manager had held his allocations passively in the S&P 500 and the FTSE 100, his return would have been 11.2%. On the basis of the information provided, the manager's underperformance can be attributed to A, asset allocation, B, stock selection, or C, stock selection and asset allocation. Okay, the correct answer is B. So number one, the fund manager underperformed, because you can see that the fund manager's portfolio returned 9%, but the benchmark return was 10.6%, okay? So first of all, that was underperformance by negative 1.6%. But also, so we want to break that attribution down. Was that because of asset allocation, stock selection, or stock selection and asset allocation? Well, if we looked at first at the asset allocation, it says here if the portfolio manager has held his allocations passively, the return would have been 11.2%. Okay, so that was based on the asset allocation. If they just would have left it at the asset allocation and not gone further to security selection, it would have had a return of 11.2%, and that's better than the benchmark return of 10.6% by 0.6%. Okay, so that means that there must have been a negative on the security selection, because the manager didn't get 11.2%. The manager got 9%. So 9% minus 11.2% equals negative 2.2%, and that is attributed to the stock selection decision. Okay, so the correct answer is B. Now, just going back, though, you can see, I just want to point out one thing. If you understand the asset allocation decision, said, okay, it made underweighting and overweighting decisions versus the benchmark. If they just would have left the allocation at that, it would have been 11.2%. And that was a positive. That was a positive decision. That was skill, 0.6%. Asset allocation was positive. So you can see here there was underperformance. That on the basis of the information provided, the manager's underperformance. Well, no, it's not asset allocation. That was positive. So A and C has to be wrong, and B has to be the right one. C can't be right because it can't be both. No, asset allocation was positive. Okay. Anyhow, that's the last slide for this topic in this chapter. And that is the conclusion for this video, the topic being Module 7, Industry Controls, Chapter 9, Performance Evaluation for CFA Institute Investment Foundations Program. Thank you.